What I hope to do is take you through a few slides here very quickly and leave an ample amount of time for the Q&A with myself and our guest, Woody Benson, who Michael will talk about a little later. So the first slide here you see is, I call it Once Upon a Time, because what I really want to focus on today is the early part of this spectrum where you look at seed and startup financing. This used to be a pretty well understood and well mapped, where stage, amount, and risk often determined the source of financing, and entrepreneurs pretty much knew who to go to for money. What I'm going to show you is that many of the elements and the availability of money is still there today, but in greater amounts and from a greater number of people. So when you think about it, founders are still the number one source of seed capital today. And how do they do that? Well, they get it from their savings, personal savings, from credit cards, home equity lines of credit, and even personal loans where they personally secure the loans with their own assets. The other area is friends and family, still probably the number one source of capital for all different types of startups, not just high tech, but startups of all kinds. And the friends and family area has grown considerably, and it's become very popular. And I think that's because of the comfort level of individuals have with understanding startups, or at least they think they understand how they work, and just a greater wealth out there as well. The other area where a lot of change has occurred is angel investing, and there are simply just more individual angels and more angel groups. This is a challenging area for people to understand because there's so many segments of angels and what it means. I like to think of angels in several groups. One is just individuals. They're not a member of any particular group, but they're individuals who are investing their own money on their own account into startups. The other area that has grown tremendously is super angels. Some of you may have heard people refer to the PayPal mafia, or Facebook or Google or Microsoft executives who've made a lot of money and are now out there making rather sizable investments in startups. And then you have angel groups. Now this is where a lot of change has occurred. There are a lot more angel groups, and how these groups are organized and the manner in which they do due diligence, the manner in which they invest has changed. Some of them even look like small VC firms. And then the last is something we'll talk about a little more, called online angel syndicates, and this is becoming quite popular and growing as well. Venture capital. Traditional venture capitalists are still out there, but it is always an evolving space. A lot of people don't realize that it is a cyclical industry, and that firms either sort of grow up and move into other classes of private equity, or they go away. There is a changing that's occurring here, at least in the Boston area, of sort of the old guard moving into different strategies, and a lot of newer, smaller firms coming in. So even this area has changed quite a bit. There are now a number of micro VCs, and for a number of years, this was the fastest growing area in venture capital. And by that, I mean, loosely defined, they're people raising between 25 and 100 million or so. The next group are more traditional venture capitalists doing seed and early stage investing with probably 100 to 500 million dollars in a fund that they're going out to invest. And now there are mega VCs. There are venture capital firms that literally play across the entire life cycle of companies, from seed to early stage to growth to expansion, all the way to a logical outcome. And private equity, of course, has always been around. A lot of people ask, what's the difference between an angel and a venture capitalist in private equity? And I like to describe it as what gets discussed at the board meeting. I like to think that, and again, these are oversimplified examples perhaps, but in the angel world, what's getting talked about at the board meeting is all about the idea and turning it into a product that customers want to buy. In a venture capital board meeting, it's all about execution and revenue generation and bidding on more customers. And in a private equity board meeting, it's all about expansion capital and growing the business and growing the value of that business. But private equity firms, some private equity firms have even dipped into the world of seed and early stage. There's also sort of reward and donation crowdfunding. You've probably all heard of Kickstarter and Indiegogo as two examples. In addition to that, there are a number of accelerators and incubators, and they continue to grow. And some of these are more than just space. Many of them are getting into sort of seed funding with their own micro-cap funds as well. Corporate venture capital continues to grow. It's also very cyclical. I've been around long enough to see a lot of corporate venture capital firms, venture capital groups, and then they shut down or go dormant, and then they all come back again. Some people say usually at the top of a cycle. Grants. This is a great way for some businesses, and I don't think enough entrepreneurs really take advantage of grants. They are a little tricky. It does require very often having someone who has experience in applying for and writing for these grants. But I do know of companies that have funded as much as 50% of their capital required through grants. There's always the Small Business Administration loans and other types of government loans that are still out there today and exist, and some of these programs are growing and evolving and changing as well. Convertible debt really is an instrument used primarily by angels and early stage VCs, but there are a lot of changes even with regard to convertible debt. You'll hear about new twists to it using convertible notes called SAFE or KISS, and this concept of caps that have come into play with convertible notes. I know some investors that don't like them at all, and some people like them because it defers the conversation of valuation for a while until the company has an institutional round where someone prices the round and gives them a valuation. That debt converts into equity. I think in general you want to have keep it very simple. I like the old-fashioned promissory note if you're going to go that route at all. The other thing is debt and equity crowdfunding. This is growing tremendously. This is not the rewards-based crowdfunding. This is crowdfunding where people are actually buying equity in the company itself. So it's generally a faster way to raise capital. Some people think it's an easier way. It's in its very early nascent stages. It is evolving. So as you can see, this area down here is getting very, very crowded, and the choices are many, and that's where a lot of the confusion is around, who should I go to and at what point in time. And part of the reason for all this was the passing of the Jobs Act, which was passed in a couple of different segments in 2012 and 2014. And what does that mean? Well, the Jobs Act basically brings individuals into the world of investors where they weren't allowed to in the past, and they can invest as much as $1 million a year. So it's turning John Q. Public into an angel. As a result, there is an explosion of crowdfunding platforms that are out there. As you can see here, debt or lending crowdfunding is probably the largest right now, or is the largest. But the equity and royalty and hybrid versions are growing. I expect that equity bar to increase tremendously in coming years with all of these platforms that are out there. This is a global phenomenon, and I think this slide will be a surprise to some people who think that crowdfunding is largely a U.S. Thing. It is growing, and it's growing around the world. This is probably the most interesting aspect of the seed and early stage world. As I said earlier, there are so many more angels, and as you can see that growth from just 2010 into 2015 in terms of the number of deals that they're doing and the amount of capital being put to use. And about 60% of all angel and seed financings were for $1 million or greater in size in 2015. There's plenty of capital. I know that in the last 2 or 3 quarters, these numbers are contracting a bit, but even with that contraction, quarter over quarter and year over year, there's still billions of dollars at work, with angel and seed and Series A making up, on a global basis, about 50% of the capital that's being put to work. The other big item is that just the cost to build a business, in particular in tech, but even outside of tech. You could get a lot further on seed capital than you ever could get before. People now, originally seed capital would help you sort of get out of the house and do a little market research. You would then go and raise a Series A to actually flesh out and build a product. and that might take 18 to 24 months. Today, companies are getting very, very far on seed capital alone and a modest amount of seed capital. They're able to take the company sometimes, all the way through to launch before having to go out and raise money. And there's lots of examples of this. We'll talk about one. The thing to be cognizant of is that the seed, the mortality rate from seed to Series A is still very, very high. As you can see, about 75% of these companies do not make it to a Series A round. The other phenomenon to understand is that it's still sort of personal and family savings. The money from individuals is still the number one way to raise capital. As you can see down at the bottom, investment by venture capitalists is actually quite small when you look at the entire spectrum of companies and not just high tech and high risk high tech. Bootstrapping is very possible. This is a company recently raised a Series D of $88 million with their eyes on a 2017 IPO. But they were bootstrapped for the first 6 years, meaning that they used some of their own capital. They used capital generated by the company before they went out, and their first round was a $37 million round. So it is possible if you use money prudently. This is the question I get asked the most, which is what are investors looking for? What do they want? There's really no mystery to this at all. Investors want, first and foremost, is massive market potential. They want markets that are billions or trillions of dollars in size potentially. They want a very strong founder or group of founders with the ability to recruit other great people. So they want people with domain expertise. They want people that have a track record of success and have done it before. And the question I get is, well, if I'm just starting out and I haven't done it before, how can I check that box? Well, the only way to do that is to get advisors involved in the company that do have that experience, that do have the respect of the investors, and are going to be committed in some way to the success of that business. Not on a daily basis, but enough that it brings some comfort to the investors. Novel intellectual property. You really have to understand your differentiation and know what makes you a good bet, and then just proof that you can grow efficiently. Now, a good example of a company that's raised money recently is actually an enormous seed round of $13 million is Lemonade. But why were they able to do this? Well, the entrepreneurs were seasoned. The entrepreneurs had a track record. They had success. They had a credible business model. They identified a $1 trillion market in the insurance space. They have a very, very unique approach that they were able to communicate via their business model and their financial model. They have early customer adoption already. And it also helped that a company in that space sold for $1 billion. So it's a market that investors know there's large outcomes possibility. What's right for you? This really all comes down to knowing yourself, knowing your customers and your market, and knowing what makes you unique. Raising outside capital, be it from friends and family or institutional investors, is not for everybody. It generally involves giving up some control in the company and ownership in the company. And so only you could make that judgment as to whether you want to bootstrap your business or you want to go out and raise institutional capital. What I will say to this is that it is generally challenging to compete in an industry where everyone else is raising outside capital and a lot of it, and you're trying to sort of take the slow approach. So you have to look at the context. You have to also understand what you want and why you're out there trying to raise money. A lot of these topics are, and this topic in particular, and a lot of the other questions that are probably come to mind, are things that we will go into a lot of detail in the upcoming Entrepreneurs Bootcamp, which our next one is scheduled for January 16th through 20th here at the Babson Executive Education Center in Wellesley, Massachusetts. So I just want to make that aware that we go into a lot of detail on this and raising capital and business model development and the like during that boot camp. So now I'm going to pause for a moment and relocate myself, and we're going to take some questions.
What makes a good candidate for seed funding?
Woody, I'll let you handle that because you're looking at a lot of deals these days.
Yeah, well, what makes a good candidate is a little bit between, the person and the idea. Generally speaking, the way we all look at deals is what I would call product, market, team deal. And for the sake of a seed deal, it starts with the person. Is this a hobby? Is this something you know well? Is it a business idea? Is it a passion? So a good candidate is someone who's very passionate about whatever they're doing, where somehow, some way, we can be convinced that it's a big market. We like to use the delicatessen metaphor of how thick is the salami, and we like the thick pieces. Is this a feature, a product, a platform, or a company? And the best returns are the ones that ideas that can turn into companies.
Time and risk of VC is less than of PE. Does that mean they have a better and quick exit strategy?
I would say just the opposite.
Yeah, it is.
For VC, this is their business. So venture capitalists raise funds from institutional investors, and they have to beat the public markets. That's the reason they are able to attract alternative investment money. The best way to look at a private equity shop playing inside of early stage is to look at a craps table in Las Vegas when the heavy rollers are there. They may spread all their bets out, and then there's kind of one crazy bet on the side, a hard 2, a hard 4, or some combination. That's what an early stage is to a private equity shop, just kind of something on the side, not their main order of business. Just more of a prop bet, if you will. Maybe that could feed something, maybe that could grow into something, but nothing to do really with shortening the expectation cycle for a venture capitalist.
I think that another way to think about this is that venture capitalists are getting involved at the company at its nascent stage, sometimes just the idea stage. So there's not even a product, there's just a good idea and a business model. And the gestation period, regardless of the fact that you can get further on less money today, building a business still takes a number of years. And so VCs tend to hold companies for a lot longer than the private equity world does. As Woody said, when private equity gets involved in seed or early stage, it's kind of a one-off bet that they're making, not their core business. The core business of private equity investors is to invest in EBITDA positive companies. So these companies are already up, they're running, they have a product, they have customers. If it's technology, it's proven. If it's a business model, it's a proven business model, and they have profitability. The job of the private equity firm is to help them grow that profitability very, very quickly. Their holding periods for investments tend to be in the 3 to 4 year range. So, where I think venture capitalists, it's safe to say it's 6 to 10.
Well,
or
right
longer.
now closer to 10.
And we're now closer to 10, going 10 to 12. Matter of fact, some funds are now out there. Used to say the fund is going to be a 10-year fund, and there are funds out there now saying they're 15 or 20-year funds because in certain industries it just takes longer to build a business. So, no, VC is clearly much higher risk than private equity is, but private equity holding periods are just smaller.
What would you recommend to founders who are currently raising seed round in terms of the actual process? For example, to start, you need a business plan, a pitch deck, an executive summary, and then create a list of targeted investor list, or target list of investors. And that ends with a question mark. So what's the process like?
Well, I think every investor is different. For me, I'm not particularly wowed by a business plan, or a PowerPoint or this or that. I'm really wowed by an idea and passion and thought. I know people are like, well, I got to write a business plan. Like, so what are you going to put in the business plan when it says, this strategy or that? That's the meat of the matter, not the content that it goes in. But my number one piece of advice, really would be on what I would call flipping the telescope and try to put yourself in the investor's position and think about how much capital your project or idea could need over a period of time, and why this is a win for the investor. I think what happens all the time is the entrepreneur does their idea, and the investor's responsibility is to fund it, and that's it. Investors run businesses too, and those businesses aren't just run on hope. Well, with back to these guys, look how how passionate they are. So I think kind of the best advice is flipping it around, and what's in it for the people writing the check, and which is where most of these processes get in big trouble, because the valuation expectations, or whatever you want to call it, the caps on the note or the money valuations are at such a disconnect. If you actually look at it, it looks like the early investors are going to get killed in the lifetime of a deal. Also, an entrepreneur can say, well, I got this price or this deal, and that's a real problem out there.
I think that you're absolutely right, Woody, and in that not enough entrepreneurs flip around the telescope, as you say, and look at and think about, they focus too much on selling their idea rather than think about how they could solve solve a problem or create an opportunity for the investor group. The other thing I think is there's way too much focus on the development of a business plan for the sake of having a plan, the development of a pitch deck for the sake of having the pitch deck. One of the things we do at the boot camp is we make you learn how to present without PowerPoint, because I actually think PowerPoint has become a crutch. Very often, I know you do this because I've been in meetings with you with entrepreneurs where they want to go right into that pitch, and you always say, you know what, put your computer away. Why don't you just tell me about your business?
Right.
And then they fumble and bumble, and they can't tell you about the customer and why they're excited about it and what's unique and what's the market size. So, the thing you have to understand is there's a process to building your business model, not your business plan, but understanding the business model. And a process, as Woody mentioned, to understanding how much capital you're going to need to build a real business. Not just how much you need for seed, but how many rounds of funding might you need. If you need $30 or $40 million, it's unlikely you're going to raise that on day one. So you're going to have to, that money's going to be parsed out. You need to understand what you're going to achieve at each of those junctures in order to deserve more investment. The process of doing that makes you pretty smart and knowledgeable, and makes you able to just have a narrative where you can sit and talk to someone across the table about your business rather than rattle through a bunch of slides that...
Right. Well, let me put it this way to everyone that's listening. If you came to me and we're having a meeting and I interrupted you at slide 1 and never let you get to slide 2, would you think I'm rude? And I would say, well, I'm not. It's just that I don't absorb information the way that you want to feed it to me. I think it's rude that you want to feed it to me the way you've constructed your slides. I think it's rude that you can't sit there and talk about it and flip Rubik's Cube around and talk about it from any angle. That's one thing to consider, the over-dependency on the tools. And on these clip levels, the only reason people raise money is to raise it again. And that means you're going to get it, and I think Angelo said dollars. So if you want to have a business plan, your plan ought to state clearly what you're going to do with 12 to 18 months of capital, what value you're going to create, and how you're going to spend that money. Oh, and by the way, to raise the next round takes 4 to 6 months. So if you're going to raise 18 months of capital, you're going to be out there raising money at 12 months of capital. So you really need to have nailed some kind of proof points in the first 12 months.
That mortality rate slide that I had earlier that showed that about 75% of companies never get from seed to A, I neglected to mention that the primary reason noted in that study was that they ran out of money before they achieved any value. So you have to be achieving value with every tranche of capital you get, and it has to be meaningful. The milestones you reach have to be meaningful, not just to you, but to future investors. If you can do that, then you stand a better chance of raising capital. If you can't, you're out of business.
How do you implement a strategy for fundraising in a startup? It seems that they are always raising money pretty much when they are running out of cash.
Well, it's like, how do you plan for retirement? Look, to some extent, the CEO of the startup is always going to be raising money. Even if you're not raising money, which happens to be the best time to be raising money. Kind of paradoxical. It is the CEO's job to raise capital, build a team, develop a strategy, and get out of their way. So no matter what you do, no matter how you like it, 25 to higher percentage of your time is going to be raising money. The best way to do that is to find investors who share your passion, your vision, people that could be lifetime tenants, that aren't in it for a short period of time. So when your goal is to just raise money at the highest price, you're probably not going to get the world's greatest investors. And there are different investors at different times. The world is a funny place right now because everyone essentially is their own venture capitalist. Everyone is writing angel checks, as Angelo said. Everyone is like, in some crowdfunding thing. Everyone's involved one way, shape, or form. So that's a great opportunity for you. It's not like the mystical, magical world of venture capital where you can't even find an email address. So it's not a strategy, it's your job to keep your startup capitalized.
Yeah. By the way, just for point of clarification, because Woody mumbled a bit there, what he said was everyone's writing angel checks, not Angelo checks.
Oh.
But if you want to write me a check, I'll gladly take your money.
Bitcoin, do you take Bitcoin?
I'll take Bitcoins too, yeah, sure. Yeah, and I think you're right. I mean, a good part of the CEO's job, and it depends on how much of their time, but a good part of their time is spent raising capital.
Yep.
And keeping, even if they're, as you said, even if they don't need the capital, but still to be out there in the market, talking to people, potential investors, keeping them abreast of what you're doing, because you eventually will need to raise capital.
And just remember, people only write checks for one of two reasons: fear or greed. So they're greedy if they think everyone else is getting them the deal they want in, and they're fearful if they think they're going to be left out. Those are the primary motivators.
That's great. And with that, I think we'll turn it back over to Michael. Thank you, Woody, for your time today. Really appreciate it.
Will he write
It was
an
fun.
angel check?
If he could write a check, I'll take it.
Okay.